Hi everyone, welcome back to the podcast. Josh with me just finished recording our video, which you guys would have seen yesterday. This is a podcast for tomorrow, so that's why you see me sitting in the same place, looking rather the same from yesterday. So this podcast was recorded yesterday and it's not done today. Today's podcast will be recorded and probably come out tomorrow. We're trying to get into a kind of schedule, so this gets more frequent and more reliable than erratic and one-off here and there and everywhere. Anyway, getting back to the podcast, what am I going to talk about? I'm going to talk about, I thought I'll do a series on, a lot of you have been asking, what is the intrinsic value? What is the intrinsic value? How do you evaluate? How do you evaluate? And no matter how much me and Anand and Shashwat, even Kesav has spoken about this, there's still a lot of confusion about this on how intrinsic value is calculated. So I thought I'll do a series on this, how evaluation is done. Oscar Wilde once described a cynic as someone who understands the cost of everything but recognizes the value of none. Let me repeat this. He's someone who understands the cost of everything, understands, but recognizes the value of none. So this sentiment mirrors many investors who treat investing like a competitive sport, always always aiming to outpace others. At heart of a wise investing is a simple principle: never pay more for an asset than its true worth. Let me say that again: never pay more for an asset than its true worth. This means before making any purchase, one should always strive to understand its value. So, some might argue the value is subjective, suggesting that if other investors see the worth in a certain price, it's justified. He's buying it, so must be right. Warren Buffett is doing it, so must be right. Anand is doing it, so must be right. But this perspective is flawed. While the value of art, like paintings or sculptures, might be based on perception, financial assets are acquired for anticipated cash flows. Justifying a stock's price by assuming someone else might pay more for it later is like a risky round of musical chairs. The looming question is, where will you stand when the music stops? There are two parts to assessing value. While there's a plethora of valuation models out there, they all boil down to two primary models. One is the intrinsic value, the other is the relative valuation. So let me break this down. Intrinsic value starts with a straightforward idea. The true worth of an asset is based on the anticipated cash flow. Let me repeat that. Its true worth of an asset is based on the anticipated cash flows it produces through its lifespan and the level of uncertainty surrounding those cash flows. So it's basically like having a tree saying, in this lifetime, this coconut tree will produce so many coconuts. At the same time, understanding this coconut tree might get an infection, some tree disease, or a cyclone may come and destroy this crop, or some other kind of calamity may fall on it. So, putting all this together gives you the intrinsic value. It's a true worth of an asset based on the anticipated cash flows it produced through its lifespan and the level of uncertainty surrounding it, those cash flows. It's a simple logic. Assets are consistent. High cash flows are more valuable than those with unpredictable low cash flows. For instance, a property with long term tenants paying premium rent is more valuable than a speculative one with a fluctuating occupancy and low rent. So let's say you have a choice of buying two properties. One has a long term tenant who's paying premium rent. That is, of course, more valuable than having a tenant who may be moving in and out and paying you a lower rent. So that is intrinsic value. On the other hand, we have something known as relative valuation. It's about comparing. It's about gauging an asset's value by examining the market's price of similar assets. If you're buying a house, you naturally check the prices of comparable houses in that area. Similarly, when evaluating a stock, we compare its prices to its peers. For example, let's take ExxonMobil. It's trading at 8 times its earning, while other gas giants are earning at 12. It may seem like a good buy. This is also true with Indian stocks. I just took out ExxonMobil because it was something me and Shashwat were talking about. Now, there is a staunch advocate on both sides. There are people who believe intrinsic value is the way to evaluate. There are people who strongly believe relative valuation is the right way to go about, who might dismiss So people who believe in one will say the other one is horrible, which you've seen. It's like politics. Each party believer believes his party is correct and the other party is totally wrong. It's very hard to find people who are actually in the middle. The so called middle voters, these independent voters, are very hard to find in every single part of the world because independent voters, seeing the amount of vitriol there, would rather be quiet. It's the same true as in markets. However, a balanced view suggests that both might have their merits. Intrinsic value offers a comprehensive understanding of what underpins a stock's or a business value. Yet, there are moments when relative valuation can give a grounded value estimate. Why limit yourself? Using both methods for the same investment will give you an enhanced chance of success. In a sense, a smart move is to invest in stocks that appear undervalued both intrinsically and relative perspective. So let's say you find a company which is intrinsically and relatively undervalued, then it's a good buy. So why do these evaluations matter to you? Why are we always harping about evaluation, evaluation? Anand talks about it. Everybody on the internet talks about it. Warren Buffett talks about it. Value investors is based on that valuation, value. Every investor steps into the market with their unique perspective and strategy. Unique perspective and strategy. Some are quick to jump in, hoping to capitalize on market surges. You've seen them. Market is going up, so time to move in. While others, like Anand, meticulously select stocks, banking on their growth and future earnings. There are those who meticulously study price charts, identifying themselves as technicians. You've seen these guys. And there are believers in fundamental analysis, deep diving into a company's cash flows, determining its value. So, whether you're in it for the quick gains or the long haul, understanding valuation, for instance, those who time the market can leverage evaluation tools right at the onset of to gauge if a particular asset class, be it stock, bonds, or real estate, is undervalued or overpriced. Stock enthusiasts, on the other hand, can rely on valuations to discern which companies are at bargain price and which are overpriced. And yes, even those who swear by technical analysis can use valuation insights to spot the momentum shifts and the stock trajectories. But here's the thing, valuation isn't just confined to the realm of investing portfolio decisions, it's woven into the fabric of a company's journey. Consider budding startup mulling on over expansion. When they knock on the doors of a venture capitalist or private equity firm for funds, the slice of the company which they part with hinges on its value. All these companies grow and contemplate about going public. It's its valuation which dictates their initial public offering price. We have seen this in Zomato, we have seen this in Nika, we have seen this in all of them. All of these unicorns which have gone public and the ones which want to go public. As they mature, every pivotal decision from investment to borrowing to shareholders' returns is influenced by their perceived value. And it doesn't stop there. The world of accounting is also evolving with a significant shift towards fair value accounting. That's why Deloitte walked away from Adani. This means assets now reflecting in balance sheets at their current value are just their purchase price. So even a quick glance at a company's financial statement demands a grasp of valuation principles. In a sense, understanding valuation isn't just beneficial, it's becoming more and more essential. Understanding the realities of valuation. I keep saying evaluation. No, why? Guess it's just a long day it's been for me. Before we dive into the intricacies of valuation, it's essential to grasp some fundamental truths. These insights will not offer perspective when evaluating others' valuation, but also provide reassurance when you embark on doing your own valuation journeys. But remember this, every valuation carries a bias. What is a bias? It is your point of view, your opinion. It is not scientific. That means it is hegged on social science, your opinion, your outlook, what you think is right, what you think is wrong. So every valuation carries that bias. Rarely do we approach a company's stock or evaluation with a completely open mind. More often than not, our perceptions are shaped even before we start crunching the numbers. You've seen this with Anand and Reliance. You've seen this with Anand and Tata's. You've seen this many, many times with other people talking about their favorite companies and their not so favorite companies. This inherent bias begins with the very choice of the companies we decide to value. Perhaps a news article influenced us, or a financial expert's opinion, like Anand swayed our judgment. This bias continues as we gather data, annual reports, financial statements, while rich in data, also carry companies' narratives, often painted in favorable light. If you read any annual report, you'll see the beginning where the guy, company CEO talks, the chairman talks about in great eloquence about how great this company is, how well they've come far this far, and how they plan to go, where they plan to go, how they plan to go, how they plan to give shareholders value. So you've seen this. Professional analysts are not immune to these biases. Institutional pressure, we have seen this in mutual funds. Pressures play a significant role. For instance, equity research analysts might lean towards issuing a buy recommendation, primarily to maintain a harmonious relationship with the companies they track. You've seen this in mutual funds. Why is this mutual fund? Anand will tell you. These mutual funds are the only ones who are buying this Adani company, or they're buying the only ones buying Reliance. Why? Because to keep a good relationship with the owner of the huge company, they have to do these things. So you as an investor have to pay attention to this when you're buying into. This is why we say avoid active funds. This employers might also exert pressure, especially if there are other businesses dealing with the same company. Let me repeat this. Their employers might also exert pressure, especially if have other business dealings with this company. You've seen this, where the company is multifaceted and has many divisions, and mutual funds might be just one division, or banking might be just one division, and the pressure they face from other divisions can influence the decision of the analyst or the manager. Furthermore, compensation structure for the analysis, which might reward them to identify undervaluing stocks, can further skew their perspective. We have seen this where me and Shashwat have done videos about this, where this shareholding pay on what you call performance based pay, all this kind of leads to further skewing. Data and metrics also show you your evaluation process will be inevitably mirrored by your inherent optimism or skepticism. If you're a very optimistic person about a company, your way you're measuring and looking at the data will look only at the positives. You won't be able to see the negatives. The same way, if you're feeling very negative about the company, you won't be able to see the positives at all. You can only see the negatives. This happens to everybody, including me and Anand. For instance, if you are favorably inclined towards a company, you might project higher growth rates and downplay the risks. Post valuation adjustments, like adjust adding premiums to positive attributes or detecting for negatives, further amplify these biases. We have seen this. This is the main reason why I say each of you should do individual analysis. All of you keep asking me on Instagram, should I invest this? Should I buy this? I'm like, no, you do it, the study. If it feels right for you and if it's a good buy for you, then go ahead. We can only teach you the method, but then you have to form your own understanding using your own biases and see if it is the right thing for you. It's crucial to acknowledge and confront these biases. Ask yourself, what drew me to this value, this particular company? How do I feel about this leadership? Do I have a personal stake in it? Documenting these biases before starting can be very beneficial. Focus on your research on hard data rather than opinions. Prioritize financial statements over analyst reports. Analyst reports are useless. And when assessing someone else's valuation, always weigh the potential biases influencing their conclusion. That includes even me and Anand. When we are saying something is great, something is awesome, remember to weigh our potential biases influencing our conclusions. Remember, the more biases, the more skeptical you should be about the evaluation. Even Buddha has said this many times. He has told this that, and I've repeated this on this platform. Don't listen to what I say as a truth. Take what I say, go analyze it further, and what you find after you hear it analyze, that is your truth. The same thing is applies to valuations. The imperfect nature of valuation is from a young age, we are conditioned to believe that following the right steps leads to right answers. If something's off, we must have made the error. This mindset, while fitting for disciplines like math and physics and other sciences, doesn't quite apply to valuation. In the world of valuation, even the most meticulously crafted ones can miss the mark. That means even no matter how much data you've studied, how carefully you work not to use any biases, you can still miss the mark. Why? Well, several factors come into play. Even the best informed at hand, translate the data into future projects is challenging, and a misstep can skew the entire evaluation. This is what's called the butterfly effect. Moreover, the trajectory we imagine for a company may not align with reality. The company could outperform or underperform our expectations, leading to discrepancies in the actual earnings and cash flows. Take my experience with Reliance Industries in the early 2000s, for instance. I did not anticipate the rapid diversification and expansion in sectors like retail and telecommunications, leading me to undervalue them. At times, even if a company's progresses just as we predicted, external factors can shift in macroeconomic landscapes, can throw our valuation off course. Interest rates can fluctuate. Economies can surge and slump. Unforeseen events can shake the industries. In 2008, my evaluation of ICICI Bank, one of India's leading private banks, serves a case in point for me. Looking back, I was overly optimistic, the failing to predict the challenges the Indian banking sector will face during the global financial crisis. The level and nature of uncertainty differs across companies. Valuing a startup brimming with potential carries more unpredictability than assessing a well established firm. This is the main reason we say avoid small caps. It's essential to recognize that a precision isn't the ultimate yardstick for valuation. Dodging Dodging the task of evaluation due to looming uncertainties isn't the solution either. That means you can't avoid doing the evaluation just because you're like, okay, you're telling me all this is of no use, so why are you even talking about this? After all, every investor grapples with the same uncertainties, even Warren Buffett and Charlie Munger. And while it might seem counterintuitive, sometimes gathering more data and diving deeper into analysis can amplify uncertainties and rather than diminishing them. So keep it simple. Over the past 2 decades, valuations have grown increasingly integrated due to two main factors. First, the rise of powerful and easily accessible computing tools and facilitating data analysis. Second, there's an abundance of readily available information. The crux of evaluation lies in determining the depth of detail to incorporate. While detailed analysis offers a chance to harness specific data for better prediction, it simultaneously demands more inputs. That means more data, yes, can offer you better prediction, but that means you need to put more and more inputs into it, which can take a lot more time than sometimes is needed. This is not necessarily increasing the chance of this also not only increases the chance of errors, but also leads to convoluted models, which you have seen. Even me and Cases spoke about people even losing astrology to use as evaluation models for markets. Sounds absolutely crazy. Taking a cue from the principle of pharmacy, often seen in physical sciences, here's the golden rule: always opt for the most straightforward evaluation model. It's what Feynman and Einstein and everybody else has said. Sometimes a simple solution is the right solution. So always opt for the straightforward valuation model, the most straightforward. If an asset can be valued using three parameters, avoid complicating it with five. If a 3 year forecast is enough for a company projecting a decade ahead, might be overreaching. In a sense, simplicity is always the key. Many investors shy away from valuating companies, citing reasons like integrated valuation models, lack of adequate information, or overwhelming uncertainty. Yes, while these concerns aren't entirely baseless, there shouldn't deter you from giving it a shot. So valuation methods can be streamlined and offer, and even with limited data, you can do informed decisions. You can take and do some kind of valuation. Remember, the future is always a mystery. Will you make mistakes? Absolutely, you'll make mistakes. Me and I've made mistakes. Anand's made mistakes. There's nothing wrong in making mistakes, but so will the rest. Remember that. Key to successful investing isn't always about spotting on, but rather making fewer errors than the majority. To conclude, this is my first in the series of evaluation. Thank you for joining me today mm, about the realms of evaluation I've been talking about. As I conclude, let's set our sights on the upcoming exploration, what we're going to talk about in the future episodes. One is what I want to talk about is mastering investment essentials. Then I'm going to talk about unraveling time, value, risk, and data analysis. Then we'll try and talk about understanding the core principles of the essence of time equals money and tackling the challenges in risky investments. And of course, we'll also talk about the basics of financial accounting before we decipher the data of informed decisions. By the end of this series of podcasts, you will have a complete investor's toolkit, is what I'm hoping, at your disposal. So stay with me and Anand and Shashwat and Kesav here as we get into this journey with you guys, and see you in the next one soon.